Hello and welcome back to Alpha Ambition. So in today's video, we're going to talk about some blue chip companies that are available at a highly discounted price. Now, when I say blue chip companies, these are all large or mega cap companies. They've got a valuation of billions and billions of dollars. I'm not picking up any smaller companies that may be available right now on discount, but these are really big companies with very strong brand names. They've posted great earnings in the past, and there's a strong future earning growth prospect as well. Now, the fact that stock market is down a lot recently, many of these companies have lost their valuation disproportionately higher than some of the other companies, especially the tech stocks. Now, this drop in valuation could be because of various reasons. For example, we have seen instances where companies have actually beaten their earnings estimates, and yet the company stocks have performed poorly in the last couple of months purely because investors are expecting them to not just beat the estimates but beat it by a large margin. Further, there is a looming risk of higher interest rate environment, which is of course something which is going to happen in the future. The Federal Reserve and the central banks can't really go on a money printing spree, and they would have to basically hike the interest rate at some point in time to slow down the inflation, which is anyway red hot right now. And on top of that, many of the stocks have enjoyed crazy high valuations since the start of the pandemic, when people basically started pumping in money into the stock market, which has basically taken the valuations of a lot of these companies to literally to the moon. So in this video, I'm going to particularly talk about 3 Canadian companies that have a very strong international brand presence. And we will analyze why these stocks have fallen. And given that these stocks have fallen disproportionately higher than some of the other counterparts in the industry, is this the right time for you to buy the dip? And guys, if you stick till the end, I promise you that 2 out of these 3 stocks are, in my opinion, are the stocks which are buy and forget, because these stocks really pack a punch in terms of their past performance, their business model, their international brand presence, what they're doing in the future, and expected future earnings as well. Alright, with all of that out of the window, let's start with number 1 stock on our list today. And a quick footnote there, all these 3 companies that we're going to be discussing today are the companies which are very important for the Canadian economy. If the Canadian economy has to do well, these companies will have a major role in actually doing well in the future. So number 1 on our list is this Canadian tech giant, which is called Shopify. Now, Shopify doesn't need any introduction, but this is a Canadian multinational e-commerce company headquartered in Ottawa, and the company provides e-commerce solutions to small and medium-sized businesses. And essentially the whole drop shipping model and the newer websites that have coming along are all based on the Shopify platform. And not only they provide a platform to build websites, but there are all sorts of different tools which basically manage the back-end operations, inventory, finances of these stocks, and even payments facilitation as well. Now, Shopify is a high growth stock, and this basically shows in its stock performance in the past as well. But with all of that growth actually comes a lot of risk as well, and it's a highly volatile stock. So if you are somebody who is a risk averse investor, you should, if not stay away from this stock, but not invest heavily in this stock, because definitely there's going to be a lot of volatility involved with the stock. Just looking at the stock performance, the stock has already lost about 66% of its value from its peak back in November 2021. Now, that's a huge drop for a company of its size. Essentially, putting it in words, the company has lost about 2/3 of its market capitalization, and it's currently sitting about $100 billion. Now, drop in the Shopify stock is just not a Shopify problem. It seems more like an industry problem where a lot of e-commerce companies and IT companies and tech stocks are losing valuation like crazy, because the fact that these companies have gained valuation like crazily in the past as well. Now, it's a simple law of nature. Something that goes up has to come down if the fundamentals of the company don't justify the valuation. And that's exactly what has happened with Shopify. Now, when I talk about the fundamentals, don't get me wrong, Shopify is a very solid business. We can look at the financials of this company and we can truly tell that there is nothing wrong with the fundamentals of this company. Now, looking at the fundamentals of the company, we can see in the last couple of years, the total revenue has only grown. The total revenue is actually quadrupled, almost quadrupled from 2018's revenue. We can also see that the net income has been consistently increasing for Shopify, so that's also great. Even when you look at parameters like EBITDA or EPS, these have all been increasing. You can see a little chart over here which shows that how the earnings have actually grown in the past. Looking at what the analysts say about Shopify, we can see that the recommendation rating over here is somewhere between buy and a strong buy. So definitely it shows The stock is undervalued quite significantly, where the average estimate for the stock price is at $1,900, while it's currently sitting at about $764. Further on top of that, we can look at some future indicators as well. For example, earnings. Here we can see there's a steady increase in the earnings in the future. Revenues are also expected to grow. EPS, which is the earning per share, is also expected to grow in future. So all in all, what I'm trying to tell you is that there's nothing fundamentally wrong with Shopify. The fact that stock is already broken down and it's come down to 1/3 of its valuation, this may be the right time for you to invest. Another point of argument that I want to make here is Shopify is a huge company, and the product that they have cannot be easily replaced by any other company. Imagine how often do you see a $100 billion or $200 or $300 billion company coming to the top and just disappearing from there. So Shopify's of the world are not made every other day. And given the product that these companies have, the skill sets in terms of the talent that they have, it cannot be easily replaced by any other company. And that is why this is one stock that I'm personally going to buy and hold on for a long term. Now, second on the list is Magna International. Now, this is again one company which doesn't need a lot of introduction. And interestingly, I've made a video and covered Magna in my dividend stock video. So if that's something that you've not watched, I'll place the link somewhere over here. Definitely give it a look, because this is one stock which is not just fundamentally strong, but also pays out good dividend, decent dividend. So you can not just hope to earn from the stock price appreciation, but also a consistent steady stream of dividend as well. Now, looking at the stock performance of Magna, we can see that from its peak, the stock has tumbled about 37%. Now, for a company of that size and that big of a clientele and international brand presence, that is a very sweet opportunity for you to look what is happening with Magna and if there is a buying opportunity over here. Okay, so let's try and make a case about it. And looking at the financials of this company, we can see that there's a lot which is going in favor of this company. According to analysts, it is trading at about 58% below the estimates of its fair value. So this may actually pose like a very good buying opportunity. Earnings are forecasted to grow about 22% the next year. The earnings have actually already grew by over 100% in the last 1 year. And the fact that it pays a reliable dividend stream of about 3% shows that the company is stable and it is able to deliver the dividend without any fluctuations. And similar to Shopify, this again seems like an industry problem and not a Magna specific problem, where the industry has actually fallen in sync with the Magna stock. Apart from this fall in the stock price of Magna, Magna as a stock is actually considered a low volatility stock. Looking at some of the financial statistics, the debt to equity ratio is pretty decent at about 32%. The profit margin here is at about 4.8%, while the gross margin is about 14.2%. So all of this actually indicate that there is nothing fundamentally wrong with Magna per se. Now, on top of that, Magna being an auto part manufacturer and big strategic partners to a lot of automobile companies, is heavily investing in the electric vehicle future. And for that reason, I'm investing in the stock and going to be investing for a long term. Now, going on to the third stock on our list today is Bausch Health. It's a Canadian multinational pharmaceutical company which is based out of Quebec, and it develops, manufactures and markets pharmaceutical products and branded generic drugs. The company has been around for a while. It was founded in 1959 and has a market capitalization of over $10 billion and about $9 billion in revenue each year. So it's definitely a heavyweight company in its own segment. Looking at the revenue numbers, market capitalization, and many other factors, we can say that Bausch is definitely a strong company, company which is basically very well established. However, the financials don't look as strong. Unlike the other two stocks that I spoke about today, this one I am a little cautioned about, and I'll tell you why. Now, similar to Magna and Shopify, this again seems to be an industry specific problem, that the industry overall is losing money and the stocks in these companies are losing value. Now, while a lot of analysts believe that this company is actually undervalued, I would be highly cautioned here because the company is so well established and still not making money. Earnings are in negative, and negative by a far margin. Yes, the company has shown some growth in their earnings, where the earnings have become less negative from higher negatives in the past. But again, if the company is not making money, I would still be a little cautious whether to invest or not. And further looking at the analyst predictions on Yahoo Finance, we don't really see, a great signal coming that this is a company that should be, on the radar in terms of like outperforming the rest of the market. So for that reason, I am particularly out for this company. And you can tell me in the comment section below whether this analysis makes sense for you or not. And if you have something to add on to this analysis, please definitely let me know in the comment section below. So quickly wrapping up, let's try and understand. The company stocks are falling. What can we actually do about it? The short answer to that is we can't really do much about it. But the fact that a lot of companies are available at a discount, which are very fundamentally strong companies, there is definitely a buying opportunity over here. So ultimately the question is, should you worry with all that is happening in the stock market right now? Well, if you're a trader, then yes, there may be some signs for you to worry because you can really lose money if you're basically into speculation of stocks. But if you're an investor and really sticking to the companies which have strong fundamentals, there's nothing to worry about. Pick on companies which are very strong and buy the dip and you're good for the future. Alright, so that's all for today's video. Thanks all guys for watching till the end. And if you have, please do not forget to like, share and subscribe. And I'll see you in the next video. In the meantime, take very good care of yourself. Thanks and bye-bye.